Welcome to Mindset Matters, the official podcast of Oregon Realtors. In this podcast, we dive deep into the secrets of top-performing agents, market trends, strategies, tips, and tricks that will transform and elevate your real estate career to new heights. Follow or subscribe today, and stay tuned for a podcast that's not just about real estate. It's about mastering the mindset for success. Good morning. Today we have a return guest to the podcast, TK Keene, Insurance Commissioner and Administrator of the Oregon Division of Financial Regulation. As we continue with our Insurance Talk, the Home Edition podcast series, TK has agreed to come back and review some of the concepts we already covered, along with what's ahead, discussing relevant legislation and other important industry information to help you educate your clients and consumers on all things home insurance. Welcome back, TK.
Thank you.
Can you please provide a brief refresher on what the DFR does in your role as commissioner?
So, Division of Financial Regulation is Oregon's insurance regulator. And what that means is we regulate the solvency of insurance companies, making sure that they have enough money in their bank accounts to make good on the promises that they've made to consumers. We also field consumer complaints in that sometimes people run into situations where the contract isn't followed or state law isn't followed. And in those situations, we can step in and assist consumers on resolving those disputes. The final piece is really making sure a huge compliance function for us, ensuring that all state laws are followed. So we have a set of market conduct examiners that dive into what our property casualty or life and health companies are doing and ensuring that when a law passes or a law changes, that those changes are fully implemented.
So let's go back to the first part of what you do at DFR, financial solvency of the insurers. So can you break that down just a little bit? When a company, a carrier, applies to write in this state, they do it through your organization?
Yes, that's correct. And so right now we have over 100 companies that write in the homeowners market in Oregon, which is outstanding and provides a diversity of different products for consumers. Companies come to Oregon and apply here, and we go through their finances and make sure they have enough money to operate, to do business, and they provide a business plan. And so we confirm that they have the finances to follow through with that business.
So when they provide you a business plan, are they saying, we only plan to write in this part of the state, we're only going to write these type of homes, we're going to cover it all? And so that's how you assess the financial solvency. They want to do this, they should have this much money in the bank, and if they don't, then what happens?
That's right. And if they don't follow through, there's a whole series of levers that we have to pull. The first being that you might not be admitted to Oregon if your business plan and your finances aren't in good shape. And that's our first tool in making sure that all of the companies we have sufficient funds to do business here.
If the DFR determines they're not going to be admitted, the carrier, they still can write in Oregon. It's just going to be at whatever premium. What does that mean? They're not a preferred carrier, or they can't write any business in Oregon?
So usually the applications we get are for the admitted market, which is a standard set of policy features. And so they would not be allowed to sell that product. They could hypothetically appear in the surplus lines, and likely the way companies do that is through setting up a completely different business. So many companies run an admitted market carrier and then a surplus lines carrier and don't necessarily have crossover between the two.
So two entirely separate incorporated businesses?
Totally, yes.
Okay, so would that be common?
It's pretty common. Companies, especially as there's been moves afoot more nationally to create large insurance companies, oftentimes they have several different companies operating under one umbrella, and they sell different products in different markets. And so it's not that uncommon.
Can you explain how that plays out in real life? I mean,
sure.
Just use company A.
Well, yeah.
I'm trying to visualize and understand exactly what that looks like for a consumer.
So imagine one of the prominent national carriers, company A, markets nationally across the board in advertising and doing TV commercials and everything. That company may have a specific admitted market company in Oregon. They may also have one or two or three surplus lines companies, and they all are under that same one large company umbrella.
So why would they need to tap into a surplus line for a consumer? A consumer goes to company A trying to get a policy. Sorry, we can't write you because of A, B, and C, but there's this company that could.
That's possible. We see less of that happening. Usually the reasoning for the way they have it structured is purely to keep the different businesses and lines completely separated and legal entities different. What we see more commonly is that consumers go to an independent broker and they might get offered 3 or 4 different admitted market products. Or if they can't be offered admitted market products, there is a linkage then possibly to the surplus lines company.
Got it. So that's the difference between a big, we're going to call it captive.
Not a captive. No, it's a big, you could call it like a holding
You
company
have a lot
structure.
more vernacular than any other industry.
We do. We absolutely do. But yeah, a large holding company structure. And really for the consumers day to day, the most important thing that we emphasize, because it is a terminology swamp, it is a difficult system to navigate. And when you think about it, how often do you to really buy property insurance?
True.
It's like maybe a once or twice a year thing, ideally. And so you come at it from that consumer perspective, relatively unfamiliar with these terms in your day-to-day life, unless you happen to work in the insurance industry. And what we advise consumers to do is work with independent agents that can offer a whole slew of products and companies versus just one particular company. And that's most often, I would say, where we see consumers maybe have difficulty in finding coverage is that the shopping experience now, particularly in some parts of our state, is just more intense, and it requires more work for consumers and more work for agents, unfortunately, because the products just they're not as readily available.
And is that because of the state of our times?
Yeah, largely it's a state of our times. So carriers have to manage their own risk profile, right? And so what that means in practical terms is you can't have, as an insurance company, too many houses on one city block in a high wildfire area because you're really financially exposing yourself. And similarly, you can't take on too many people in one region. Carriers not only have to look at the price point and the products offered, but also look at concentration risk is what it's called. Just making sure that they don't have too many properties in one part of the state.
The insurers look at a whole slew of data to determine what sort of business plan they want to propose in Oregon. And you review and say, oh, okay, makes sense. Let's see. Okay, you have enough money. You're good to go. Let her rip. Then as the year goes on, and let's say we might have a couple unpleasant natural disasters, do they go back to their portfolio and say, holy smokes, we have all of the properties and items we agreed to assure, we've had to pay out claims on half. That means if we're going to continue doing business in this market, we're going to have to submit a rate increase or we're pulling out.
Yeah,
what do you see?
Jenny, that's spot on. And so carriers, even with their initial business plan, are constantly assessing their risk, their scope in terms of what's not only happening in Oregon, but what's happening in the Western states and even more broadly throughout the United States. And so it's not intuitive to most people, but a large hurricane season in Florida can impact what products and what the span of offerings is in Oregon or Washington or Idaho, any of our Western states. Just because, if there are large losses and it is driven by claims, then you'll see carriers want to shrink their footprint, become financially more conservative because they just could not withstand like a corresponding large wildfire season in Oregon, Washington, Idaho, as an example.
So what happens, here's a what if.
Yeah.
A carrier submits their business plan. You determine they're financially solvent based on what their plan is. Turns out to be a really bad year.
Yeah.
And they do not have enough money to pay the claims that they thought they did.
Sure.
But because of circumstances, they now don't. What does the insurer do in that situation for the insureds?
Yeah, that's really a cornerstone of our financial protection for consumers and the solvency regulation piece. So 2 things. One, most companies buy something called reinsurance, which is insurance for insurance companies. Reinsurance is a global market, and it offers that base of support for companies, but it offers it in a global market. So it is impacted by things like hurricanes and other disasters occurring worldwide. We don't regulate reinsurance companies, but we do make sure that our companies have enough money and they've bought sufficient reinsurance to do business in the state. And so there is what you would call a financial backstop. So in an ideal situation where a carrier has a lot of claims, they'll take steps to, 1, access the reinsurance based on the terms of that, but 2, if needed, exit the market, ease out of the market, do those things. Now, if we hit a catastrophic situation,
As determined by who?
The solvency position of the carriers. If hypothetically they've got more losses than...
Who defines catastrophic? Is that a global term in the insurance industry?
It's a term of art, and it usually is covered in the reinsurance agreement. But really, if we have an event where a company runs out of money, there is a guarantee association backstop. And so every company pays into what's called the guarantee association to make sure that if something happens where there is an insolvency, which is the equivalent of a bankruptcy, that the claims can still be paid. Now, the key thing to know about that is that it has hard caps. So consumers are unlikely in that scenario to be made completely whole for their losses. And that's why what we do is so important. Checking on the front end that they've got sufficient funds, managing and overseeing what carriers are doing in the market at present to making sure it's not too financially risky. Because we've not seen consumers go to the Guarantee Association or the Guarantee Fund in recent times, but two, really making sure that all of our companies are healthy enough to do what they're trying to do in Oregon.
So since the wildfires, how many companies have you seen tap out or say, we don't have enough money to pay our claims?
Yeah,
and
so
the insurers kick in
Oregon, we haven't seen companies go to the Guarantee Association. We've seen exits from the market, and prominently, Sublimity Insurance, who has eased out of the market and is in the process of doing that.
Is that a big admitted carrier?
It's not. It's one of our smaller ones. It's a mutual insurance company. It's been here, over 100 years now.
So it's a homegrown.
It's a homegrown, absolutely. And also, Oregon Mutual has transitioned to a different business model where they've gotten out of personal lines, selling to consumers entirely. They're completely business focused now. We've had other companies that have decided to scale back, what they're offering in the state. We've also seen companies in the last couple of years come to Oregon and start offering new business and pursuing new opportunities here. And so we're in a much different spot, I would say, than some of our Western counterparts, and that there's an eagerness to do business here.
The homeowner side?
On the homeowner side, on the property side, generally, I think comparatively, we're better positioned as a state to take on some of this risk. And people are seeing that some of the actions by the legislature, $68 million this session to go towards mitigation, is meaningful, and that there is an attempt here to try to curtail the risk. And so companies by their nature are always looking to write good business. And so part of our job, working with state fire marshal, working with forestry, is to improve the insurability of the state.
Do everything you can to mitigate and make Oregon a desirable place for these carriers to come in.
Absolutely.
And the more carriers, the better it is for the consumer, right?
The better it is for the consumer, the more opportunities. It just benefits everybody.
So where do you find data to support some of your decisions? Are there certain resources you use? Would they be similar to what the carriers use, maybe when they're doing their risk analysis?
That is a great question, and we have improved by leaps and bounds in this area recently. Historically, we have the authority to do data calls and ask companies questions, and we've used that authority fairly regularly throughout the years to get high-level insights. This last year, we were part of a national data call to gather homeowners data from all 50 states.
Verbal survey type of thing? Or send some out to all insureds?
Oh, it goes to all the companies, and the companies, it's actually by law, and so they have to respond truthfully to the information that's being requested, and they do. And so we've gotten some amazing insights, and we're getting ready to do another round of that. The current data goes through 2022. The next version is anticipated to go through 2026.
Imagine 22 was interesting, and it should be better, it would seem now. 22 was so soon after, I'm sure a lot of claims were paid.
Yeah, and we also have seen, we all did our own data call on reinsurance. That's been a curiosity for a lot of people. And what we have heard is that, companies are paying twice as much money for half the coverage now. And through that data call, we found out that unfortunately is true in Oregon. And so, hopefully with the mitigation efforts going on at the state level, with some of these changes that we're making, we start to see an easing of that reinsurance pricing too.
Oh, there's so many factors that go into assessing premiums and whether people write. What county in the state of Oregon is the most expensive to live in from a insurance perspective, not a home cost?
Oh, man. I don't have that information at hand. I'm happy to give it to you and attach it to the podcast as soon as I know it. But we don't really analyze it at that level of granular. We've got data about non-renewals and cancellations by county. But in terms of cost, it's really difficult to say, because some of it also is based on the home value, right? And so that differs pretty greatly throughout the state.
So it's not just based on risk, it's cost to replace is a
Yeah.
factor. Let's talk about non-renewals real
Yes.
quick. So you have data on non-renewals.
We do.
And which counties might see the most non-renewals?
Yeah. It's through 2022. And so really would want to get a perspective of what the current is. But I would say far and away, the number one cause of cancellations and non-renewals is non-payment, which we're digging into and trying to understand further. The other thing I would say on non-renewals is that it's a little bit of a deceptive statistic in that, so if you were a member of Oregon Mutual, they were your policyholder, or you were the policyholder to Oregon Mutual or Sublimity or any of these, you're going to have to be non-renewed so that you can transition to a different company. And so we already know just right off the bat, the statistics are going to be colored by those sorts of withdrawals from the market. It doesn't indicate that person hasn't found other coverage. Really, the bellwether that I use when we're talking about data is how many policies do we have in the FAIR plan? And right now we're about 2,000, which is about where we were 10 years ago, which to my mind is an indicator that people are taking steps to improve their property, to make it more insurable. They're going back to the admitted market and finding coverage. So you would expect if people couldn't find coverage that the FAIR plan numbers would be quite a bit higher than they are right now. So the fact that they're not tells me that people are.
Can you give a 2-sentence explanation what the FAIR plan is?
Absolutely. Yeah, sure can. So the FAIR plan is our market of last resort. So if you cannot find coverage in the admitted market with your standard companies, then you can access this additional product, which is the Oregon FAIR plan. And it offers property only coverage so that you can satisfy mortgage and lending related obligations. There's also ways through that plan to buy general liability coverage. And so it is an expensive option, but it is also very valuable to the state in that it does provide that last.
It's very bare bones.
It's very bare bones.
And not to dive into the FAIR plan too much,
Yeah.
since that's a whole other topic. If someone is getting insurance through the FAIR plan and their home is worth more than $600,000, they're going to need supplemental surplus wraparound. What do we call the coverage?
Yeah. Basically, the FAIR plan director has to go out and find coverage in the reinsurance market to cover that. And he has done it. I believe last count, we had about 30 policies that were in that situation where Steve Steinbeck, who is the director of that plan, had separately gone out for those folks and found coverage in the reinsurance market. And,
is the FAIR plan, are they reinsured? Do they have reinsurance?
They do not have reinsurance right now. They're in the process of getting
carriers.
Yep.
Okay, enough on the vernacular. Yeah. We're going to get into the weeds, and I think it is interesting, but perhaps there's other ways we can educate our listeners on the weed conversation, even though I find it fascinating, which maybe says something about me. So let's talk about in the limited time we have left, the recent legislation.
Sure.
And I think one of the things you just talked about, House Bill 2563, what applies directly to non-renewals and notifications. Can you talk about that recent House bill that was passed in the 2025 session?
2025 session, yes. And so we've been on a long journey of providing consumers with greater levels of transparency by law. So companies, 5-6 years ago, were giving out non-renewals, cancellations, and those sorts of things with very, very little information. It would just basically say you've been non-renewed. And, as a consumer protection division with that focus, one, that drove a lot of phone calls. People wanted more information as to why and what could they do. And so that is really part of 2563, is really getting into the granular for consumers on that individual property level. It's not just, you were non-renewed because we had too many houses in a given part of the state. It really is, what can you do to make yourself more insurable on that individual property level? And also the reason for the increase, increase or non-renewals.
Is it non-renewal or just when there's a rate increase too?
Rate increase as well, yeah.
So I have a property. My insurance rate, I just got my renewal, and it's going up 25%.
Yes.
Which I don't know if that's typical. I don't even know what average is. I can request is it automatic that they will provide the explanation with the new
Yeah. So we're in
Where do you have to
administrative, we're
request?
making on this right now. But the idea is that consumers will be able to request to the company the granular explanation.
And they have to
And they have to
respond back
provide it.
if they receive a request, but it's not automatic up front. So I get my bill and I'm like, holy moly,
Yeah.
call the company.
Yep.
Company would then
Provide the
say,
information.
this is why, A, B, and C.
Absolutely.
In that explanation, do they also have to include how you can potentially get your premium rate reduced? Or is that a whole separate combo?
No, they do. And it also is, what we've been really working on with 2563 has been getting to the granular of what are the elements that make sense to consumers to include. And so things like, did this property particular geography change in some way internally, or is it the age of the property or the structures on the property? And so it's really trying to give that feedback to what they could do to become more insured.
So your organization is developing a template for the carriers to use when they receive these requests.
That's correct.
So this request, is it only for renewals?
No, it's for cancellations as well. It would be encompassed in it. But then you'd also have the rate increases. And so a rate increase would be a situation where you could make that request.
Got it. Okay. So what is the average annual rate increase for the average homeowner?
Yeah.
I know there's probably a wide range, but what are you seeing?
Yeah, no, and we don't have that level of aggregated data to know. I mean, I can share and others have shared, significant increases, in the 10 to 20 to 30% range, even for geographies that really aren't wildfire impacted. And when you look at the reasoning for that, we're seeing increased labor costs and costs overall to do rebuilds right now. I mean, it's getting very expensive on a square foot basis, even in the Salem metro to rebuild. And so that has to be taken into consideration then in the carrier premium charged.
On rate increases, if a carrier is going to increase their rate, do they have to submit an approval, a filing with you? Is this an annual thing? What does a company have to do?
Typically, it can be as frequent as every 6 months. Usually we see companies on a 1-year cycle. And what we do is we have 2 actuaries on staff, and they go through the rates and make sure that they're actuarially supported and justified. And there have been times where we have said, this isn't actuarially justified and required carriers to change rates. But more often than not, they are supported with good evidence. They have to provide data to support the requests that they're making.
How often do you tell a carrier, and I know you might not have this data, but how often do you tell the carrier, oh, sorry, not justified?
In terms of a hard no, it's very infrequent, but I think it's more of if there's missing information or things that we don't see, it's more of a conversation of hey, we're going to object to this, or we can't approve this. And
they can provide it with it.
Yes, you can provide it to prove it, or change the rate downward in alignment with what our actuaries think.
Does it ever happen that a carrier submits a filing and you say no and they can't justify? They say, well, we're out of the market. We're not going to sell here anymore.
We haven't had that occur. I think by the time they get to their rates, they've really made the big picture business decisions to stay in the market. We haven't had that occur. And carriers have other levers to ensure that they don't oversell a given product or take on too much business. There are some other options for them in that scenario.
Lots of factors. All right. Tell me about Senate Bill 85.
Senate Bill 85. So this is, we're working with the State Fire Marshal, the Department of Forestry, and an organization called the Insurance Institute of Business and Home Safety, which is IBHS. And they've done a lot of work in the Southeast on hurricanes and mitigating for hurricanes. They're using those same principles on wildfire-related property risks. And so the idea is IBHS and the State Fire Marshal are going to come up with actuarial values for different components. So, for example, hardening your roof, creating that 0 to 5 feet of defensible space. That all has some tangible value that we feel like isn't being recognized right now in the rates. And so the statutory structure is in place that once we have the science to match, the actual risk and what's happening, we'll be able to potentially require companies to take those kind of discounts into account in their rates. But
so is Senate Bill 85 really for the consumer or for the carrier?
Well, it's really for the consumer, because consumers are doing a lot right now to mitigate the risks, but they're not seeing all of those things being reflected in their premium.
So Senate Bill 85 lists criteria to harden your property, steps a consumer can take to mitigate their risk, which in turn should play out in their premium.
That's right.
And so then the consumer can say, I've done all these things that Senate Bill 85 outlines.
Right.
Mr. Insurer or Mrs. Insurance Carrier, my rate should reflect this. Why does that?
It doesn't put the onus on the consumer anymore. The idea would be then, there's an actuarial value to hardened roof. You've got a hardened roof. And so then we would check the rate filing to make sure that is taken into account in the rate.
Got it.
Yep.
So with their rates, they could say it would be rate A if consumers have done A, B, and C. If they haven't done A, B, and C to their property, they're looking at rate B, C, or D.
Yeah. Exactly.
Oh, a lot.
Yeah.
Okay, last but not least, tell me about Senate Bill 829.
829 is really impactful. It is an affordable housing bill from the governor, but the key thing that it does is it looks at the possibility of a reinsurance program run by the state or other similar options that we could do to either hold steady or even reduce the current rates that are offered in the property markets. And so we're going to do a big picture study with actuarial and economic analysis to say, hey, if you had a reinsurance pool of, like, the state put in 60 million, what would that get you in terms of helpfulness to consumer rates on homeowners insurance? There's a corollary there with the ACA and the health insurance markets. There's a reinsurance program now that operates in the state on the health side to reduce rates by 6 to 8% each year. And so it's been bantered about as a question for a long time. And now we're getting to really, I think, the primary questions, which is for property, how much would this cost? Are
all three pieces of the bills, the legislation we talked about, are they all effective January 1st already?
We're already working on, the transparency bill with the rates is going through rulemaking right now. 29, we got started right after, 85, we got started right after the passage. We did a demonstration burn with IBHS and the state fire marshal that was publicly held just to kind of launch the project. And in so doing, highlight what mitigation can do to a home versus a non-mitigated home and how fast they go up. So that work has already started. And then the 829 work is right now with our procurement team, and we're going to have a contract out soon to have a third party come in and do that analysis for us.
Your work is never ending.
That's for sure.
So, TK, is there any other pieces of legislation, do you think, right now that have passed or are in the works that will be relevant for homeowners insurance and consumers? I know we're going into a short session.
Yeah.
But for 27, anything on the horizon that might be helpful where our organization, could work together with your organization to help the consumers, which of course include our members?
Yeah, I think 2026 will be kind of telling to see. Typically it's a budget session. There may be some, in fact, I know there will be some homeowners proposals put forward just to see what could float in moving forward in 27. But I think the big thing will be, as we get into the work that we've just described, are there things that we need changed from a statutory perspective to either implement them for consumers or make them more effective? Right now, we've passed a lot of different pieces of legislation in Oregon the last few years. And so I'm really excited to kind of see how all of these things play out and really where the holes are and try to address those in 27. So there's not a particular concept right now top of mind for the division in terms of 27, but I'm sure legislators have some ideas, and I think the eventual study on reinsurance could yield a big idea.
It sounds like there are some great opportunities for the Realtors and the DFR to partner up on perhaps creating some fact sheets that we can distribute to the consumers and to our members to help them educate their clients. In the meantime, where would you recommend that our members and other listeners go to find out everything they ever wanted to know about homeowners insurance? And I know you cover it all, but we're just talking about homeowners insurance.
Yeah, dfr.oregon.gov. And we've also got within there our publications, which has different guides to buying property insurance. We do outreach to the entire state. We're on our third year in a row of hitting all 36 counties. And so we go out in person and we table and provide our information, also with the Fair Plan and Steve Steinbeck and the Oregon Realtors at specific events. And we're happy to continue to do that. I think it's a really great partnership and just making sure that everybody is on the same page. Realtors play such an important role here. They're the trusted messenger between between consumers/homeowners and what's really taking place throughout the state. And so really appreciate the partnership and the credibility in the conversation that realtors provide.
Thank you, TK. We appreciate you and your team as well. I think our members are on the front lines of hearing from their customers saying, I got non-renewed, or I was canceled. What do I do? And we want to help them provide the resources for their customers. So thank you for being here as always, and we'll look forward to having you back. We could go on and on and on because I like the weeds. Thank you, TK.
Thank you.
Happy holidays.
Thank you.